Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Jun-sok, professor of economics at the Catholic University of Korea. Professor Young, good afternoon. Thanks for making time today.
Happy to be here.
Well, last Friday we saw stocks on Wall Street retreat a bit from their recent gains. Investors worried about earnings at companies like Snap and Twitter. For the week, though, it was a gain for the main indices across the board. What's the story in the global markets as we start a new week?
Okay, well, for the last week or two, the stock markets around the world seem to be somewhat unsure, and there's much volatility, and there doesn't seem to be really any steady underlying trend. It seems to be just skimming water, more or less, for now. As you said, Friday, the Dow Jones, S&P, and NASDAQ were all down between 0.4 to 1.9%. But for the week, all three indices actually rose. Dow Jones by 1.96%, S&P by 2.56%, and NASDAQ by 3.33%. Bit of a both good news and bad news is that oil prices are down from a high of $104 on the 19th of last week to about $94 today on concerns about global recession. If the oil prices keep on going down, that may mean that we won't have to worry that much about inflation as time goes on, but we will have to worry more about global recession. But on the short term, if the oil prices continue to go down, then we expect the Fed to raise the rate by 0.75 percentage points on when they meet on the 27th, which under normal circumstances would have been bad news. But because we had fears that they might raise it by a full percentage point, it's now looked on with a more or less a breath of relief. The markets are right now more or less satisfied with the earning reports that are coming out. Bank earning reports have been beating or meeting expectations for the most part, and tech stocks, at least until last week, middle of last week, they seem to be doing well. Netflix reported that they'd only lost about 1 million subscribers rather than 2 million that they were expecting. But last Friday, we had some problems with a couple of tech companies, especially Snapchat, which caused a drop in tech stocks, which caused the lowering of the stock market on Friday. But overall, the earnings report is coming out better than expected. About 21% of S&P companies have reported their earnings. About 70% beat expectations. But still, that doesn't seem to be enough to stem the uncertainty about the market. Alphabet, Google, Amazon, Apple, Microsoft will report their earnings this week. And the stock futures before opening on Monday is slightly higher, and year-to-date Dow is down 12.8%, S&P by 17.4%, NASDAQ by 25.3%. European market, the European Central Bank raised their rates by 0.5 percentage points on Thursday, which was more or less expected, and markets seem to be shrugging off the rate increase. But we should remember that the stock markets went up after the Fed reported their big step on the interest rate rise, but it fell soon after, so we should keep an eye on that. But Europe is having some political problems, the UK with the fall of Johnson administration, and then there's problems in Italy now as well with resignation of Prime Minister Mario Draghi and the fall of ruling coalition, and there's more talk about fragmentation between strong EU members and weak as the worries about global recession rises. And a bit of a surprising news, Russian central bank lowered their interest rates by 1.5 percentage points, reducing their key interest rates to 8%. So at least financially, they seem to be returning to pre-invasion normality. But there was an article in Foreign Policy last week that said, in terms of the real economy, goods and services, Russia is heading into some serious problems. In Asian markets, Tokyo, Shanghai, and Hong Kong fell on Friday and fell today. Japan's consumer price index inflation was 2.2% for June year on year, and the Bank of Japan is likely to retain loose monetary policy for now. Hong Kong tech index has fallen, which accounted for a drop in Hang Seng. Financial Times reported that China will sort U.S.-listed Chinese firms into three groups, depending on sensitivity of the data they hold to satisfy the U.S. regulators, and that seemed to have led the markets, especially tech stocks, to drop in the Hong Kong stock market.
Well, here in Korea, stocks a little shaky starting out this morning, but foreigners, institutions were net buyers. In the end, a little bit higher on the KOSPI, a strong showing for car makers coming off their earnings last quarter. Tell us about the domestic market.
Well, KOSPI seemed to be doing relatively well. Last week, KOSPI rose by 2.7%, and today it rose another 0.44% to end at 2,403.77. And foreigners bought and individuals sold, and the fact that they ended above 2,400 is catching some news. Hyundai Motors did very well today due to news that state of Georgia has agreed to give property tax breaks over the next 3 years and corporate income tax breaks over the next 5 years. KOSPI, they done very well last week, rose 3.6%. They did not do as well today, but they're down very slightly, down 0.01%, ended at 789.70. Individuals and institutions bought, foreigners sold. Year to date, KOSPI is down 19.6%. KOSPI is down 23.9%.
Well, Professor, this week we'll have consumer data from the Bank of Korea, which should give us some idea of how people are feeling about inflation right now. Also, the Federal Reserve's big decision on interest rates. What's on your radar in the week ahead?
Okay, well, the big Korean news is going to be twofold. The one is Tuesday, the Bank of Korea is coming in with the advanced preliminary second quarter GDP numbers. It's expected to be in the positive, but less than 0.7 percentage that we saw in the first quarter. Right now, they're betting about 0.4%. As you said, Wednesday, we have the July consumer trend. On Thursday, we have the business sentiment index, export and import price index in terms of trade. And on Friday, we have the June financial institutions weighted average market interest rates. And then for the foreign data on U.S., Tuesday, we have the consumer confidence index, which would show how strong the future demand is going to be. Wednesday, as you said, the Fed FOMC meeting. And then the Thursday, U.S. GDP growth for second quarter, the preliminary numbers, it's expected to be in the negative, which means that technically U.S. may already be in recession, even though the demand is very, very strong.
All right. Sounds like we're going to have a lot to look through in a few days. Professor, thank you, as always, for coming on the program. We appreciate it.
Thank you.